Welcome to NREI's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at NREIOnline.com. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. Let's dive into this week's top stories. Hello, David. How are you?
I'm doing well this week. How are you?
Fantastic. It's been a wonderful week so far, and looks like you guys have covered a lot of stuff.
Yeah, we're going to do some more highlights this week.
All right. We like highlights. So what are the stories we're going to be covering?
We have a report from a National Seniors Housing Conference that's taking place right now, actually. We also have the latest information on what's going on with WeWork's pending IPO. We've talked about WeWork a couple of times, so just sort of an update on what's happening with them and what people are thinking. Then I got a couple of just sort of quick bullet items this week. One, just looking at the latest investment sales figures for the sector and just what that's telling us about how people are feeling and maybe what we should expect for the rest of the year. And then lastly, an update on what's going on with multifamily construction financing.
All right. So the first one was NIC Fall Conference. Just kind of some of the takeaways from that.
Yeah, it's the National Investment Center for Seniors Housing and Care, NIC. It's their fall conference taking place in Chicago this week. I think there's about 3,000 people at it. It's probably the biggest show of the year devoted specifically to seniors housing investment. So that's going on right now. One of the things that they were focusing on, at least in day one, this is sort of like recapping what happened. The conference is kind of like, while we're recording this, the conference is sort of in progress. So this was what I'm going to talk about is stuff that came up during the first day, and then next week we might touch on stuff that happened on the rest of the conference.
All right, sounds good.
So one of the big points of discussion during the first day of the conference was identifying an opportunity in the sector that may be underserved at this point, because typically private pay seniors housing has a fairly high price point, and then you have publicly funded or Medicaid, people who are using on Medicaid at sort of like are in another part of the seniors housing space. And what they've identified is that there's sort of like a gap, that there might be demand for seniors housing, but people that maybe can't necessarily afford higher price facilities, but are above the thresholds for Medicaid assistance.
All right.
So according to a study that they did, that there's going to be over 14 million middle-income seniors by 2029, which is about 6 million more than today. Mm-hmm. And this is this is a part of the market that they're identifying as not currently being served by the seniors housing sector.
Got it. I mean, that's a huge chunk.
Yeah. It just goes along with the aging population. It goes along with just other macro trends, but just having this segment of the population that might not have a solution if the market continues the way it's going right now.
Yeah, that's a scary thought for a lot of people.
Yeah. So, and again, so NIC is primarily, dealing with private companies that are and investors who are in this space. So what their study is saying is that if the biggest stumbling block here would be the costs for the out-of-pocket costs for the residents. Mm-hmm. So if there's a way, they're identifying essentially an opportunity that if we could carve out a part of the sector that is below the current average costs and may be able to soak up some of this potential demand for people that currently there isn't a good fit for in the existing seniors housing space. So currently, the average out-of-pocket cost for an assisted living facility is around $60,000 a year. So according to their study, if operators can lower that cost to $50,000 instead, that approximately 2.5 more million seniors could then afford to move into the facilities.
Which would be a very positive thing, obviously, for the seniors. How would that affect the overall market then?
So I think obviously if they're paying less out of pocket. It means that you'd have to find a way to cut your expenses if you're going to lower the price, be able to lower the price point for seniors moving in. So I think that's I guess the ultimate, like, one of the takeaways or the challenge, I guess, that they're trying to push forward, is that for operators, if you can find a way to lower your cost of capital or somehow lower your cost of operations without sacrificing the level of care that you're providing at these facilities, then you might then it creates the opportunity for people that currently couldn't come to actually now take it, live in the facilities that they would need to.
Do you think this will start a trend to build larger facilities to be able to have more seniors in bulk, for lack of better terms? I mean, really, right? I mean, if you're lowering it by $10,000 per year and you're looking at building a facility, you may think, okay, well, I'm going to have to make either the rooms a little smaller, right? Maybe we do that a little bit and put in 20 more rooms so that we have more to offset that difference in cost. I don't know. I'm not in the market for that at this point, but I'm just curious how they're going to try to balance that out.
Yeah, I think that's the open question, which is, I don't know if they necessarily have like a one set recommendation for how costs could be streamlined, but they're just sort of like providing a figure for if kind of throwing it back to the industry. If you can do X, then it will mean Y for serving potential demand in the space.
Gotcha.
And again, they're pointing at this as a potential growing demand in the next decade or so, given the number of seniors they're projecting that would fall into an income range that could be served if the costs just weren't so high.
Yeah, no, that makes sense.
So I thought that was they put out. I think we actually wrote about this study earlier in the year, and there's a story on our site about it. But if you just go to the takeaway, the takeaway piece itself has a link, I think, directly to their report, to the write-up we've done, and a couple of other supporting points that are related to some of these broader points that I just talked about.
Yeah, definitely, people should go check that out.
Yeah. So I think that was like the biggest thing. Then one other, just quick data point from the conference, which is that they just pointed out that, because NIC also is a pretty important maintainer of statistics within the space in terms of like average rents, average occupancies for the different sectors. So they reported that actually nursing home occupancy had its first year-over-year increase since January 2015. In the first quarter of this year. So I thought that was interesting, just given that the overall, demand that you think there would be, that there is or would be for the full range of seniors housing options, that it's been actually a few years since the occupancy rate ticked up specifically for nursing homes.
Yeah.
So those are the main points from this piece. And now I want to move on to talking once again about WeWork, which we've talked about a few times on this podcast.
I like WeWork so far.
Yeah. Well, a lot of people do, and a lot of people have questions, and that's what makes it such an interesting story. I think for me, what's emerged as, I think what's been interesting is, now they filed for an IPO. So with that has come a whole new layer of transparency about the company. Things that we had questions about. This company has created so much buzz, and they've spent, they raised a lot of capital, private capital, had all sorts of private investors come in and helped fuel their rise. And then we were always wondering, like, how are they making money?
Yeah.
The more that we've gotten to look under the hood, okay, they're not making money. They're pushed, but they're still like have so much buzz around this potential going public, much more than you would think for. And I think part of what it gets at is like whether you understand WeWork as a real estate company or something else. Because if they were a real estate company, their valuation would, if they were seen as a real estate company, it seems like their valuation wouldn't be seen the way that it was, at least earlier in the year. And I think that's one of the things that's kind of come out as people continue to look at their business model and just sort of, see that they're ultimately they've got their hands on a lot of other things. I think we've talked about, like, investing in schools and fitness and all sorts of other sort of ancillary businesses, but their core business remains either buying or leasing office space and then releasing it at a higher cost to smaller tenants, and trying to, like, basically leverage that. And in addition to that, providing a whole layer of, for the return for that is, you get your internet, you get meeting facilities and all sorts of stuff for people that aren't necessarily in a position they don't need a full-time office, or they're transitioning to the point where they would open a full-time office. WeWork is your incubator space.
Yeah. Do you think people are looking at this point through rose-colored glasses because of all these other bells and whistles kind of things that you're bringing up? Or
I think they were, and I think that's we're in this process of, like, where those glasses are at least partially coming off, because one thing that's happened is that earlier in the year, back in January, when first started talking about this IPO and people are still trying to figure out how much the company's worth, the estimates of its valuation were as high as, like, almost $50 billion. And now people believe it's actually more like $20 billion.
Oh, yeah, that's a slight loss on that one.
Yeah, so that's, as far as we know. I mean, as far as they're saying, and as far as we know, they're intending to move ahead with this IPO at the end of the month. But I think there's no people raising questions about whether it's going to happen because of these kinds of questions about its business model and its prospects and what kind of company is it actually.
Okay, do you think are there answers on the horizon? I mean, is there somebody that's going to do a really good investigation of what's going on, and WeWork's going to cooperate with them to where they're like, well, yeah, no, let me show you what we're doing here. And
I mean, I think that's the process that's unfolding, because as part of the IPO, they've had to do a whole number of SEC filings. And these SEC filings now we have hard numbers about how much they're losing. We have hard numbers about how much real estate that they're leasing and they own, and can kind of, like, figure out what their valuation should be. One of the more concrete things that's happened in the past couple of weeks is the debt rating agencies have downgraded WeWork as well, partially based on, I think, seeing this information. So that's not necessarily a good sign for them.
Yeah.
If like, their cost of debt is going to be higher now because of what Fitch and the other rating agencies are saying about them. So, and I think there's still the question about, when are they going to at what point do they stop spending so much money and start posting profits as opposed to quarterly losses that they're currently logging up at quarter after quarter after quarter at this point.
Yeah, I'm sure everybody wants to know that.
Yeah. I think the other question that came up in the piece that we did is, now landlords who have, to this point, I think landlords have also had sort of landlords have struggled, I think, to figure out whether or not they should rent space to WeWork or not. And I think up to now they have, but they're starting to see WeWork more as a competitor to their core business, even while they're a tenant. So, like, okay, is WeWork going to, like, come in and provide and offer space or offer, steal somebody that could actually be a permanent office tenant instead?
Yeah, I mean, that would be my concern.
Yeah. So I think that's coming up. So, and if that, at this point, landlords have certainly leased a lot of space to WeWork across the country and even across the globe. So I don't know if that's going to slow down or not, but it's potentiality as well. I guess that's being raised by people that we were talking to.
Yeah, there seems to be a lot of ripples in the pond with this situation. Just so many layers that need to be evaluated, I guess.
Yeah, and for me, it's just like, we spent a lot of time talking about this company. That in the grand scheme of things, if they just build themselves as a real estate company, there are other companies that do co-working space, that do flexible office space, that don't have that have similar size portfolios. Maybe not at this point. I don't know where they all rank out, but don't get the attention that we were. They've done a tremendous job of getting a lot of buzz about themselves, and I think they've done it, and that has partially fueled this IPO investor interest. But then I think increasingly what we're seeing is that, like, all right, if one of these other companies that essentially does the same business, flexible office space, co-working space, if they were doing an IPO, they wouldn't be getting this kind of attention.
Yeah.
And some of them are actually already public companies and don't have those kind of valuations that what we're talking about around WeWork. So I think that raises some, that raises some big questions.
Yeah.
So I think what we're going to see is hopefully within another, at this point they're doing their roadshow. I think the IPO is scheduled for around the end of the month. So I think soon we'll have, we'll have an answer as to what, if they proceed with that, what an answer as to how the market is going to value them. And then I guess we'll see going forward what their operations look like.
All right. Well, I know you'll keep us posted.
Yeah. So, that's just our latest checking on WeWork. Hopefully we will, I guess we'll probably have maybe one more before the IPO, but hopefully we can talk, we'll try to talk about some of the other parts of the business too.
Yeah.
So now I just wanted to touch on some data looking at what's going on with overall investment sales volume within the commercial real estate sector. A couple of the big data providers and brokers have put out first half numbers. And overall, what we saw in the second quarter is a year-over-year gain in overall investment sales volume. According to CoStar, they put the figure at $130 billion for the second quarter, which is a 14% year-over-year increase from the second quarter of 2018. But with that, they've also raised, as well as CBRE, as well as Real Capital Analytics, other people that are watching the space, raised the prospect that we could be seeing a slowdown in investment sales activity.
Mm-hmm.
Partially that's attributed to because we're seeing a slowdown in funds raising money for the space. So therefore, less funds having less money or raising less money means that they're going to invest less.
Yep.
And I think there's just this overall sentiment that I think that we've talked about a couple of times, which is, this cycle at this point has gone on much longer than any other growth cycle for commercial real estate. I think there's just a general level of caution about A, the length of this cycle, and B, some uncertainty about the overall economic conditions that may just lead to people thinking a little longer about the deals they're making right now.
Of course. I mean, a lot of people are talking about, a lot of advisors out there are talking about what's up with the next recession. We know one will come at some point. We don't know when, but here's, some of the indicators that we're seeing. So I think it's wise to be cautious from any standpoint. So it makes sense that they are at this point.
Yeah. And I think that the question is for real estate, how, if there is a broader recession, how much will it hit the commercial real estate sector? Mm-hmm. So I think it depends on where we see the slowdowns. What's the cause of the slowdown overall? How much, anything that's going to affect demand will trickle down to affect demand for real estate. So, I don't think there's a scenario where we have a recession and real estate just floats by, but I think certain factors could have a greater impact on how deep and how much the commercial real estate space gets affected by it.
Yeah, and absolutely. I'm just not ready to patent my crystal ball yet. So
yeah,
once I get that done, David, you and I will have another conversation. But yeah,
exactly.
Nobody knows.
Yeah. Another notable trend, though, within looking at what's going on in investment sales is that foreign investors in U.S. property became net sellers of U.S. real estate for the first time in 7 years. Mm. So that was sort of an interesting takeaway that was pointed out as a warning sign, specifically by CBRE and RCA. They did say that it's a flashing more of a yellow light than a red light when looking at that figure, but they both pointed to it as an interesting data point about what's been going on in the market, that foreign buyers are have pulled back a little bit for the first time in a while when looking at U.S. real estate.
Yeah, either way, it's a flashing light, and that's it's still going to make me pause, right? So, yeah.
So, I think net deals are getting done. It's not like deals are not getting done. People are still buying commercial real estate. There's still a lot of money that wants to get the returns that commercial real estate can offer, especially I think with what's going on with interest rates. There's the relative yields makes real estate still an attractive proposition if you can, if you feel pretty good about that property's leases and underlying tenants and all that kind of stuff. But I think there's a little bit of caution that we should be aware of.
Mm-hmm. Mm-hmm.
So that's kind of like what those numbers are telling us. Our last piece that I wanted to touch base on is also a similar kind of sentiment. But in this case, we're looking at multifamily development and specifically construction financing for multifamily development. We're finding that suddenly, because of how much the cost of construction are rising, lenders are becoming more hesitant to finance development.
Yeah. A lot of hesitation in these stories.
Yeah.
with good reason, I'm sure.
Yeah. Again, like I said, similar kind of feeling. We're late in the cycle. People feel like that at some point there's going to be a dip. So just no one's tapping, full stop on anything, but there's just, people are just trying to be careful. So they're not being as aggressive with loan terms. They are not being as aggressive with investment, as we talked about in the last story. Mm-hmm. But specifically here, what we're talking about is that in terms of like the kind of terms that lenders are giving multifamily developers is now they're only maybe 2 years ago, they were willing to finance a development at 65% loan to cost. Now they're saying 60% loan to cost. They're not keeping they're not keeping pace with the way that the costs of construction are rising on a year-over-year basis, which is partly being affected by tariffs. And to be kind of bringing the full context here, some material, the cost on some materials is rising 10 to 15% annually at this point. So development's getting more expensive. Lenders are not are not willing to lend money to keep pace with those rising costs. So that's going to put some additional pressure on developers in terms of if they're able to move ahead with projects or not, because they're either going to have to put more of their own equity in, or they're going to have to pencil their deals out to accept a little bit lower yields than they were anticipating because of their capital costs, and the amount of capital they're getting from lenders is different than what it was a couple years ago.
Got it.
So it's not to say that lenders are not financing construction, but they're just being more cautious.
Mm-hmm.
sort of our theme. That's for the day.
Theme for the day.
Yeah.
So Sesame Street had letters and numbers and things, and today the word of the day is cautious.
Yeah. Yeah. I'm feeling very, very self-conscious about saying it a lot, but I don't know, other than saying hesitant, cautious, that's but people we're talking to, that's what they're saying.
That's it. Those are the facts. That's what we deliver.
Those facts.
So,
that's, I think, that as with all of these stories, I think, folks should go to the website. We talk to a lot of folks in the space. So there are people experts on all these pieces that we've quoted, links to the full reports on all 4 of these pieces. So please go to, NREIonline.com to check them all out.
Fantastic. And there's other headlines that are on the website that they should be checking out. How long will true diversity elude commercial real estate? Could a recession impact boutique fitness studios more than big box gyms? And another one, student housing developers focus on tier 2 schools for new projects. So those are all on the web, ready for people to download and read.
Exactly. Those are, we had a little bit less this week because of the holidays, but we still have a lot of coverage for people to check out.
Absolutely. All right, David, thank you so much for your time.
Thank you.
All right. And thank you all for listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these with your colleagues. Thank you so much for listening today. For everyone at NREI, this is Aric Johnson inviting you back next week for all the news that matters to you. We'll talk to you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of NREI or Informa. The content has been made available for information and educational purposes only.